way for today. And what otherwise has been fairly quiet in terms of overnight news, not a great deal going on, but certainly a couple of topics to catch up on. Certainly, Bank of England saw a bit of focus yesterday, and there was a bit of equity volatility. I think I saw a stat the Deutsche Bank was saying about it's basically the first time in several weeks that we've finished lower than 0.2%. Now, this kind of unprecedented era we're in of very low volatility kind of continues to that respect in terms of the closing price, despite a brief momentary downside that was seen really at the open of Wall Street yesterday. On that note, one thing, looking at the DAX, very choppy price action yesterday, and really it was around the time of when Mark Carney was delivering his press conference, which began at 12:30. We saw an extended move to the downside, and people obviously asking the question at the time, why is it moving lower? What is it that he said? And I would say something like Mark Carney speaking to lead the DAX lower, I think is a bit of a stretch. There's not a lot he could say to really pinpoint the DAX index specifically, because the FTSE definitely didn't move, which would be more correlated to his commentary. A couple things though. Technically, we broke a previous support level kind of fairly short term, and then what tends to happen is when you have a fairly quiet market with low volatility is when it does start to pick up. It might be automated systems or algos kicking in, and then one fires another, and you get this extended kind of pronounced move in the market. The one thing that I tend to do in this type of situation is I ask myself, well, I double check, is there any news? Have I missed anything? Has anything gone kind of under the radar that might have moved this? And within about 30 seconds, the longer you do this job, the more kind of conviction you have in your belief or authority, I guess, that you haven't missed anything. At that point, you're kind of thinking, well, this sell-off looks a little overdone because it's not really based on anything other than, I'd say, technical break and momentum selling. Then what happens? Well, you get an entire retracement. Within the hour, pretty much, the entire move and some is recovered, which pretty much kind of just solidifies that thinking that this was nothing fundamental on that break. Then though, you started to get some selling, and this really kicked off, and when we hit those eventual lows about half an hour or 45 minutes into the Wall Street session, you can see that the US indices were a little bit more clearly defined in that initial push lower that we had. Again, a technical break of the lows seen from the 10th in overnight Asia Pac and early European session. But one thing that did draw a bit of attention in the equity space was a couple of retail updates coming off the high street in the US. In particular was Macy's. We were talking about Macy's yesterday. They had earnings. This is just a snapshot of their revenue change from a year earlier. So looking at Q2, where we are at the moment, a negative 7.5% puts them at the worst, certainly dating back a number of years. But you can see the gradual issue that some of these retailers in the US are having, which is predominantly based upon, well, one, people will look at it as a slight bellwether for spending sentiment in North America. But secondly, the competition of technology, the kind of slightly changing behavioral patterns of the way that people spend these days. Shopping centers, or shopping malls, if you like, are becoming less and less popular as the likes of eBay, Amazon continue to kind of grow at a very rapid pace. So Macy's shares were actually down about 17% yesterday. Kohl's, Nordstrom, these kind of other related retailers were down, I think, 8-9% kind of each as well, respectively. So the sector definitely influenced by the weakness that came out of this very disappointing earnings report from Macy's. There was a few other earnings reports as well that might have drawn a bit of attention. And some people were looking at a comment at the time from Mark Carney in the press conference where he said that they had based their models on a smooth Brexit process. Some people thought, well, that's not very well prepared for what might materialise, and that might have spooked the market as well slightly. I think it's more to do with the retail side than it is the Carney comment personally, but certainly you could pin that bit of news to that move. So let's just have a look at the pound. Maybe a bit of a recap as to why it moved and then where we are at the moment in terms of market pricing. And if I make this a 15-minute candlestick so we can look at the actual price action. And really the selling in cable yesterday was a two-part deal. It was the 9:30 data when that came out. This is when you had trade balance, industrial manufacturing production, all kind of indicative of missing on expectations, so slightly weaker than expected. A lot of people though would have been a little bit apprehensive of committing too much in the market ahead of what arguably is the bigger event, so people kind of hit the short pretty quick, exit that trade, book their profits, and then you've got this natural kind of regression in the price back up. Then the main event, which was the release of obviously Super Thursday, as expected, completely no change on the interest rate or the QE program, APF, that's completely as expected. However, the vote split was a little bit surprising, although the consensus and what we were looking for, 7-1, did materialise, 6-2 didn't. And there was certainly a decent enough amount of the market, I'd say, that were looking for a slightly more hawkish split on the vote count, with Michael Saunders anticipated to have joined Christine Forbes, who's the most kind of outlying hawkish member, but that did not materialise. So maybe some of those outside bets being unwound, causing initial spike lower. And then of course you had the quarterly inflation report, hence it's Super Thursday. And what that showed were a couple of interesting things, and obviously inflation rather than growth is kind of the key metric that traders are looking at. And I've got a chart here that's mapping the quarterly inflation reports, the one that we had yesterday, which is the slightly darker line, and the one that we last saw, which was back in February, which is the slightly lighter shade line on the chart here. And what's interesting is the trajectory that they were looking for and what they're now looking for. Essentially then the Bank of England are getting a little bit more, almost front loading the pressure that they see and the peak of inflation. So they actually see the peak of inflation higher than they previously did. They see it earlier than they did before, so they actually see that occurring only in a few months' time, when we're up at around just in excess of 2.8%. But after that point, the interesting thing here is, although they see price pressures early on, they then anticipate it to fade quite quickly going through 2018 into 2019, which in around Q3, Q4, it then moves back, still above target nonetheless, 2%, but much lower than where we were looking, which would have been around 2.5% at that time of kind of Q3 2019. So if anything, they've become a little bit more dovish in their inflation outlook. Yes, they see it slightly higher, but overall they see a much quicker and steeper decline than they previously did. So that obviously might have also added to some of the dovish interpretation. Those comments we just mentioned about the models based upon a smooth Brexit may have also meant that, well, in reality, even though actually some other parts of what he was saying was, you could say, moderately hawkish, a lot of people may be a little bit disbelieving that that Brexit process will indeed be as smooth as he thinks. What does this mean then for interest rate expectations? We looked at this yesterday. This is an updated graphic, and so post the Super Thursday event, you can see that we've fallen. An interest rate increase by the end of this year has gone from where we were yesterday morning at about 28%. It's now dropped to about 18%. Consequently, the next rate rise, really, we're looking priced in, is still looking well into 2018 at this point. Going back to the chart, cable's a little bit of downside already this morning. I wouldn't say it's really too much dollar movement. It does look like some still sterling weakness. We broke through that Asia Pac low earlier, 28.88. Looking for then the post Bank of England announcement low, which would come in at 28.62, that then leading on to S1 at 28.54. So a couple of support points just coming up to keep an eye on. Looking slightly longer dated, Obviously that 28.82 is quite a key level that was breached in the immediate aftermath of the BOE announcement. That was a significant kind of area of previous resistance and support. We're now below there. So again, targeting this low point then would be S1. Below there, you'd be looking at 28.46, which would mark the low seen on the 4th of May before then what was quite an aggressive rally back up towards this 130 highs that we had just around a week ago or so. So a couple of downside levels to keep an eye on here in cable today. The way it's moving at the moment, and the fact as well that later on this afternoon, I believe on the US calendar, we've got CPI data. The PPI numbers were higher than expected in the US yesterday. Whether or not that would translate into higher consumer price index figures, but the dollar certainly did see a little bit of a blip on the PPIs last night. If that has a repeat and materializes in the CPI data this afternoon, in the context of the dovishly perceived Bank of England announcement, it could open up some of these downside levels to be tested in the session today. Okay, quick look at some other headline news flow this morning. You've had some German data. It hasn't exactly set the world on fire because it came in exactly in line with expectations. The German economy expanded a seasonally adjusted 0.6% in the March quarter 2017. So it was the strongest expansion though since the first quarter of 2016. So quite interesting to see that. If you remember yesterday, we were looking at the pattern about how the UK economy tends to have a seasonal patch of weakness at the beginning of the year. The Germans, the complete opposite. They tend to start off fairly robust when they get underway in the early part of the year. So we're back up towards levels that were not last seen since, well, really this time last year. A couple of individual stock movers to be aware of. There is still corporate earnings we're working through in mainland Europe, and a couple of UK names. Vivendi up around 4%, likewise AstraZeneca, the pharmaceutical company in the FTSE. Richemont, which is one of the largest Swiss companies, down about 5%. ThyssenKrupp earnings, DAX down 4%. BMW, who are ex-dividend today, are down 3%, and Swatch, another Swiss firm, down about 3% as well. So a bit of a mixed bag on the corporate earnings front. But nothing that's been clearly defined in terms of a direction for the index future, so to speak. One other big event that I just want to bring up that you'll need to keep an eye on, and this is not so much a tradable event, I would say. This is more of something that's going to help you guide your kind of view on Europe slightly longer term, certainly on the macro perspective. And one of the key things here is that Macron win of the presidency, obviously he still has the legislative elections coming up in June, which will really showcase what power he really has in the composition of the National Assembly in France. But that obviously has negated somewhat, a little bit, without being complacent, the belief of this populist movement may have just lost a little bit of steam. And Merkel and Germany is the next kind of big benchmark European election event. That's obviously not materializing until the back end of September, so it's still quite a way off. But what has been happening is that Merkel was a politician who was under extreme pressure. Probably only about 6 months ago, she was decreasing quite sharply in popularity due to a number of different reasons, chiefly Germany being subject to terrorism, that then leading on to the argument of immigration, Germany having very high levels comparative to other European nations, and the Syrian situation and so on. Then also this kind of ongoing contribution to southern European states, i.e. Greece, in their bailout programs, of which their likelihood they'll need another one. And so Merkel's found it quite tough to keep the German public happy of the idea of being within Europe, and Merkel being the kind of the chief guide of that ideology. But what's happened is there's been a couple of regional level elections, which, much like we had in the local elections in the UK about a week ago, people will look to that as a sentiment gauge as to how the national election might fare. And what's been quite interesting is there's been two in the last, I'd say, 2 months where Merkel has actually started to outperform what the polls have said. Martin Schulz, his biggest rival, has not been able to capture, or let's say, this kind of sentiment that we've just been talking about that's been negative for the last year or so for Merkel. He's not been able to really distinguish himself as a credible kind of alternative, maybe because Merkel sits so cleanly in the middle. So there's a risk of being too far one way or the other, right or left wing. But there's a really big election happening on Sunday. As far as regional elections go in Germany, this is North Rhine-Westphalia, which is the most populous region. And so this might be something just to be aware of when we come in on Monday. Again, I don't anticipate that it's going to move the market, but it's just interesting to see how this might shift the kind of view about the risks associated with 2017. We started this year, real uncertainty about France, potential snap election and five-star movement of Pepe Grillo causing potential danger for Italy, who are already under pressure as a banking sector, and then a risk that if Merkel was not to continue as the Chancellor of Germany, then the whole ideology of the euro is in question. But what we've had is quite a sea change in that sentiment, and recent polls going into specifically North Rhine-Westphalia has the CDU party, which is Merkel, just a pip above the SPD. But you can see how really this game has changed fairly rapidly. Where we were in, well, a month ago, fairly divergent, almost a 10-point gap. But Merkel has managed to close that, and in fact has taken a slight lead going into this. So something just to be aware of. One of the other things where I wanted to just quickly talk about, there's obviously been a lot of chatter about the VIX, about this period of very low volatility that we're currently experiencing. And just a couple of interesting points that I saw kind of graphically that I thought might be worth sharing. That's because we saw earlier in the week the VIX sunk to its lowest level since 1993. And what we're looking at here, this first chart, is the Chicago Board Options Exchange SPX, so the S&P 500 Volatility Index. And we're looking at US stocks volatility is around its lowest in a decade. People often say, what number in the VIX? Typically, through the financial crisis, the conversation was always at what level on the upside do I then start to be indicative of a market breaching kind of more panic situation. And 20 has always been seen as the kind of line in the sand on the upside, that marking the 25-year average. But where we are at the moment, or May 8th, was the lowest close since December of 1993. Now, if we scroll down to other charts here, the VIX has closed in single digits only on 11 times since its inception. I've just got those marked up here on this chart so you can see the most recent one that we've had. The one prior to that, you would need to go to really pre-financial crisis era. Now, a couple of interesting points that I've seen is about how social media is flooding people with so much information that the impact of events like the firing of FBI Director James Comey is lost. If you're having all this confusing information, you don't know which one is true, which one is false, and so net, actual stories start to have a lesser implication on underlying market prices. If I remember kind of really before the Twitter era, a story would last a lot more longer, if you like. Whereas now, what happens, because news dissemination is so fast and expansive, is that sentiment can change what would have been usually days or longer, now can last minutes before it flips again. And I think there's so many things ongoing at the same time, is that the amount of importance, I'd say, on these blips that can cause volatility is decreasing. One of the interesting things here is looking at this from an event point of view for big macro situations, and we're going into this general election, and really it just showcases the lack of stress that the market is assigning to the possibility of the UK election creating any type of volatility around it. And that's because, as we know, the Conservatives have got it tied up. It's just about how many seats is the majority. This is not a situation where you're going to have any type of surprise, really. It's just about how many seats did a Conservative capture. Is it 100? Is it more? And so on and so forth. Comparative to the EU referendum, when 1 month volatility in cable was up at levels, highly extreme levels. Last peaks that we've had, the Scottish referendum, 2015 general election, but market is, you could call complacent to some degree, but very calm at this point going into this UK election situation. The other thing here is about, and we talk about this sometimes, of central bankers who continue to relay the same message again and again and again. If you think about someone like the Bank of Japan, it's almost falling on deaf ears because we get so used to hearing one side of commentary that we begin to desensitize to it. Now, on that note, one thing that we have seen and that could potentially spark volatility is Donald Trump. But if I was to, what I'm trying to find, and I haven't done yet, is a good graphic showing the impact value that a Trump comment or tweet had a few months ago to what it has now. What I'm saying is, I think from a behavioural point of view, the market has priced in now or desensitized to Trump's erraticness. And so when he does something like firing the FBI director, or he flips on nearly every one of his kind of manifesto pledges in the campaign trail, no one actually cares anymore, because what else would you expect from the Donald? And so actually that's another reason why volatility could be particularly low, because we are now in a new, we've come to the acceptance, if you like, that this is the reality. Donald Trump isn't going anywhere, but his influence, if you like, is becoming less. So yeah, a couple of interesting things here. The final point being about the composition of bigger money at play in the market. Another common target among active managers set is to go passive and index-based investments that have flattened the market and made life difficult for hedge funds and others. So when the market is in a period, in a state of very low volatility, very hard for these hedge fund managers to find good, sizable returns for their investors. So then what happens, they start parking it in more passive rather than active investment type structures, which then almost means the whole situation just elevates and becomes even more amplified in how this market is so quiet in terms of market movement and volatility. So maybe a couple of reasons there just to have a think about to explain why we're in this type of situation at the moment. One other headline just to be aware of, you're likely to hear Trump gloating about this, I'm sure. The administration hailing the US-China trade deal, so China will open its markets to US credit rating agencies, credit card companies, as well as resume imports of US beef. Basically, it's a 10-point package revealed today, billed as an early harvest from the 100-day plan of trade relationships with China. So, you know, if you were looking for the kind of background behind this relationship, obviously Trump has reversed course and what he was deeming a currency manipulator, partly maybe to do with trying to facilitate better trade talk, but also as well to negate any escalation in the Korean Peninsula. That particular issue seems to, whether China related or not, has dramatically decreased in terms of market focus and attention compared to where we were probably about 4 weeks ago or so. On the schedule for the weekend, it is worth noting that there is a G7 finance minister meeting ongoing at the moment. That could be interesting to monitor for any potential movement in the currencies if there's any talk about Brexit negotiations. Trump is to deliver a keynote address on Saturday. On Sunday, China President Xi Jinping is due to host world leaders including Putin and Io's Lagarde at a summit, and then Emmanuel Macron gets sworn in as French president on Sunday as well. So a couple of things on the agenda. On today's session though, a quick look, and I would say focusing more short term, you need to be a little bit more realistic about the kind of allocation of your day, both being emotionally invested into the market, i.e. being in a position of risk, and then in terms of the size and type of trade that you might want to look at between the morning to the afternoon. And saying that because really there's not a great deal at all occurring at the moment, both from a scheduled calendar point of view for the next few hours and also from what's going on in the market this morning. Things are fairly quiet. In the afternoon though, things do liven up considerably, and this afternoon is actually the busiest and probably, as far as economic data goes, the most important day of the week. Talked about earlier, the PPI numbers in the US came in higher than expected, and we know inflation is a key metric that the Fed are looking at in making their policy decisions at present, and CPI data is coming out at 130, and in the context of how retail sector was weakening the overall index futures yesterday on the back of Macy's and others, you've got US retail sales for April coming out the exact same time as the US CPI report. So that's at 1:30. You've then got University of Michigan sentiment, which is the preliminary, so more important, May reading alongside business inventories. You've also got Fed's Evans kind of sandwiched in between timings wise at 2 o'clock, who is a voting member and is speaking on economic conditions. So you've got a Fed speaker speaking on topic in between a cluster of what would be tier 1 data. So retail sales in the US obviously last time was a little bit weaker than anticipated, 0.2% month over month. It was the first consecutive 2-month drop in more than 2 years, as purchases dropped in car dealers and gasoline stations. Sales declined in almost half of 13 major retail categories last month. Now, from a consensus estimate point of view for retail sales today, we are looking for a bounce back to positive plus 0.6, which would put us back at January levels. But we are coming in a period here of weak retail sales, the weakest that we've actually seen. You'd have to go back to really the end of 2015. On the Michigan sentiment front, this has been, I'd say, a fairly robust figure. Sentiment continues to track at fairly high levels. 97 has been fairly consistent, so maybe not looking too much out of this figure. The emphasis, I would imagine, will be more on the CPI situation and the retail sales report at 1:30. Okay guys, going to leave it at that, 9 o'clock, so enjoy your day ahead. If I don't speak to you individually, then have a great weekend, and I'll catch you in the chat room. Thanks very much.